once again, JP Nyans. We're very sorry for the technical difficulties met by our team. Now, to start with our webinar session, let's give a virtual applause to our first speaker, a senior JP Nyan from the body number 18, Mr. Jello Riquizo.
What is forward contract? Forward contracts is an agreement between two parties to exchange a specified amount of commodity, security, or foreign currency on a specified date in the future at a specified price or exchange rate. Atong timan-an yan, sa ang clue word or keyword nga naa sa definition nato sa forward contract, which is a specified date in the future at a specified price or exchange rate. Mura na'y mag-matter gadjod sa forward contract. Then, forward contract is customizable derivative contract between two parties. Customizable, it means that we can tailor the contract or we can speculate in the contract the amount, we can change the amount and the delivery date nga atong state sa contract na magdepende lang na sa atong gisabutan. Next is forward contracts do not trade on a centralized exchange and are considered as over-the-counter instruments. Then, forward contracts can help producers to hedge their products against a change in the price of underlying asset or commodity. Then, financial institutions that initiate forward contracts are exposed to a greater degree of settlement and default risk compared to contracts that are marked to market regularly. In a simple term, forward contract is a commitment to purchase or sell a specified commodity on a future date at a specific price. Oh, hibalik na sa datong keywords, which is the future date at a specified price. For example, this on January 1, 2019, Gentle Company expects to purchase 50,000 kilos of tobacco from the supplier on January 31, 2020 at the prevailing market price on such date. Recent market factors indicate that the market price of the bag of tobacco per kilo is within the vicinity of 150 pesos. Then, to protect itself from the variability of the market price of tobacco, Gentle Company entered into a forward contract with a speculator bank under the following terms. A. If the market price is more than 150, the excess is paid by the bank to Gentle Company. Then B. If the market price is less than 150 pesos, the deficiency is paid by Gentle Company to the bank. Then, in this, the contract is the derivative financial instrument. And the objective is to assure that the Gentle Company shall pay 150 per kilo on January 31, 2020. Ang speculation sa contract kay nag-insure siya sa Gentle Company nga ang ija na mabayran which is 150 kanang 50 pesos per kilo on January 31, 2021. Kung wala pa nag 150 pesos, ang mubayad na ingnan sa rest na bayron non sa price is ang bank bayran sila sa bayran sa bank ang Gentle Company if mo excess sa 150 pesos ang price per kilo. If the opposite, ang mubayad sa price nga deficit kibali is the Gentle Company which is naghapon sila sa range sa 150. Kay ang iyang gasto is 150 pesos per kilo, moobos, kailangan ni gihapon diyang bayaran is 150 pesos. There. Then, in that, the forward contract is designated as a cash flow hedge. Cash flow hedge means even if the price rises, the net payment will remain the same. Muna to, giingon mo ganiha nga kung mo lapas og 150 pesos price, 150 gihapon ang bayaran ni Gentle Company. If moobos og 150 peso ang price, 150 peso gahapon worth per kilo nga tobacco ang ijang bayaran. Then, the primary financial instrument is the highly probable forecast purchase of 50,000 kilos of tobacco on January 31, 2020. Sa illustration or sa example, kailangan nila, ang ilang forecast nga kailangan nila paliton in January 31, 2020 is 50,000 kilos. Then, the market price of tobacco per kilo is 170 pesos in December 31, 2019. Sorry, typo. Then, 175 peso in January 31, 2020. Next is, here is the computation. In December 31, 2019, the market price is 170 pesos. So, 170 pesos times 50,000, which is the forecast kanang kailangan natong paliton nga tobacco is equals to 8,500,000. Then, the underlying price, which is the amount of tobacco nga kailangan nato i-purchase o ang price nga atong gi-agree nga bayran ina ng panahon na, which is 150. Then 50,000 times 150 pesos is equals to 7,500,000. 8,500,000 minus 7,500,000 is equals to 1 million, which is the forward contract receivable. Kani si Jang 1 million, mo ni si Jang madawat nato nga tibali on December 31 nga receivable nato from the bank ay hilapas naman ang price ni Ja, which is 170 sa 150. It means natay ma-receive na 1 million ikan sa bank in December 31, 2019. Then, on January 31, 2020, na-auto naman sad ang market price kay di man sila kanang ingon nga steady ang iyang price, which is 8,750,000 kay ang 50,000 nga kailangan nato paliton, ang iyang price naman kay 175 mo to. 50,000 times 175 is equals to 8,750,000 less the underlying price, which is 50,000 times 150, which is 7,500,000. Then 8,750,000 minus 7,700,000 less 7,500,000 is equals to 1,250,000. This is the forward contract receivable from January 31, 2020. 1,250,000 na. Kung atong receivable pagka December 31, 2019 is 1 million, pag abot sa January 31, 2020, nahi mo na 1,250,000 kay change naman atong price from 170 to 175 pesos. In conclusion, this computation means that Gentle Company shall receive from the bank a total of 1,250,000 on January 31, 2020. That's all for forward contracts. And next, let's welcome the speaker or the one who discussed for our next topic.
Good afternoon, Junior JPians. I hope you all are doing well in your home. So, okay ra ba agahong kuan tingog dili putol-putol? Guys? Okay ra? Sige, okay ra.
Okay.
Thank you. So, I am Jessamine Ramos, the second speaker for this afternoon's webinar. So I will discuss another type of standalone derivatives, which is the futures or future contracts. So, guys, before tayo mag-start, pangutan ako, familiar ba mo og kanang mga future, mga oil futures, gold futures? Nakadungog na mo gingana? So, wa pa. I assume wa pa. So, let's all together learn what is future contracts. So, future contracts are defined as contracts as exchange-traded derivative contracts that lock in future delivery of a commodity or security at a price set today. So another definition of it states that a future contract is a contract to purchase or sell a specified commodity at some future date at a specified price. So basically, a futures contract gets its name from the fact that the buyer and the seller of the contract are agreeing to a price today for some asset or security that is to be delivered in the future pa. Hence the name future contracts. So I hope that's clear. So, nasabtan ra guys sa definition sa future contracts.
Muna.
Thank you. So moving on, future contracts are standardized for quality and quantity to facilitate trading on a futures exchange. So a ganing futures contract is traded on a future market. So participants buy and sell commodity like gold, oil, etc. for delivery on a specified future date. So when we say participants sa katong future market, this refers to the hedgers and speculators. Guys, a reminder lang, please turn off your mic para dili ta makadisturb sa kadaghanan. Thank you. So, let's continue. So, when we say participants, katong giing ganina nga, participants sa future market nga ni-engage og future contracts, this refers to the hedgers and speculators. So, hedgers are the producers or purchasers of an underlying asset wherein they hedge. So, kung may tag-hedge, they guarantee the price at which the commodity is sold or purchased. While portfolio managers and traders, money sila agatong speculators, which makes a bet on the price movements of an underlying asset using futures or future contract. So again, ganing futures o future contract, maura ni sila. So to sum its definition, futures or future contracts are derivative financial contracts that obligate the parties to transact an asset at a predetermined future date and price. So take note, this is an obligation. So here, the buyer must purchase or the seller must sell the underlying asset nga nakastate sa contract at the set price regardless of the current market price at the expiration date through exchange market. So as I have said earlier, ganing mga future contracts traded ni sila sa future exchange market. So tanang cash settlements adto settle or made through the market. So unlike the forward contract nga gisika sa previous speaker, which are traded over the counter or pwede sila rin magsabot kung asa nila isettle ilang mga kanang bayro nun sa usa ang ganing future contract dili pwede og ingana kay standardized ni nga contract which should be traded in a future exchange market. So basically, the same ra jud ni silang duha. However, as I've said, mag-differ sila on how they are being traded. Forward contract over the counter, while future contract is traded through the future exchange market. Og napay usa kami kanang main difference nila. Ang forward contract is a private agreement or contract between a buyer and a seller. So, duha ra ka party involved sa forward contract. So, pwede ra nila ma-customize ang terms of the contract kay wa may third party na involved. Unlike sa future contract na standardized, meaning both parties have the same terms of the contracts and they can never customize it regardless of who is the counterparty. So, kung sa'yo naka-state ato nga contract sa future contract, maura dito sila, dili ko pwede ma-customize sa bisag kinsa nga party. Kay naa na may third party nga involved during the PITA, which is the future exchange market. So, making this contract or type of derivative more regulated than the forwards or the forward contract. So, to summarize, sa ilang main differences, future contracts are standardized or fixed on terms, while forwards are traded over the counter and have customizable terms which are arrived at between the counterparties. So, matong hanggingan lagi kanina nga sila rin pwede, bisag kinsa rin, o silang duha, pwede maka-customize sa unsay nakasuod sa contract, sa forward contract. Wherein, ang future contract is standardized. Fixed na to siya, dili na to siya ma-customize. So, next. So, kanang para ma-illustrate siya, para imagine mo kung unsa jud ning future contract, I have here an example. So, for example, an oil producer needs to sell its oil. So, they may use, so magamit na diri og oil, kaya man kasagaran ag i-trade sa future exchange market using future contracts. So, for example, an oil producer needs to sell its oil. So, they may use future contracts to do it. This way, they can lock in the price they will sell at and then deliver the oil to the buyer when the future contract expires. So, also, sa part sa buyer, wherein usa ka manufacturing company, they may need oil for making widgets. Since they like to plan ahead and always have oil coming in each month, they too may use future contracts para ma-budget nila daan ug unsa di price sa kana nga oil. Wa nay changes. This way, they know in advance the price they will pay for oil. And they know they will be taking delivery of the oil once the contract expires. So, to illustrate this better, I have this more kanang elaborate nga illustration. So, imagine sa imong future, you're already an oil producer and is planning to produce 1 million barrels of oil over the next year. So, it will be ready for delivery in 12 months. So, assume the current price is 4,000 pesos per barrel. So you could produce the oil and then sell it at the current market prices 1 year from today. So given the volatility of oil prices, so mag-change man ang price sa oil sa market, 1 year from today could be very different than the current price. So if you think the price of oil will be higher in 1 year, you may opt not to lock in a price now. But if you think 4,000 pesos per barrel is a good price, you could lock in a guaranteed sale price by entering into a futures contract. So in here, a mathematical model is used to price future contracts which takes into account, so dili ra ni sila magpataka og price sa usang commodities out so nila future contract. So this price takes into account the current spot price, the risk-free rate of return, time to maturity, storage cost, dividend yields, and convenience yields. So assume that the 1-year oil futures contracts are priced at 5,000 pesos per barrel. So by entering into this contract, in 1 year, you as the producer is obligated to deliver 1 million barrels of oil and is guaranteed to receive 5 billion pesos. So this 5,000 pesos price per barrel is received regardless of where spot market prices are at the same time. So fixed na ni siya nga mao ni ag madawat nimo when you enter a futures contract. So kung napangutan mo nganong naaman day ning future contracts nga naman day og edit sa nilag baligya. So what purpose does it serve? So future contracts serve two purposes, which are for speculation and hedging. So future contract allows an investor to speculate on the direction of a security, commodity, or financial instrument, either long or short, using leverage. So like many derivatives, future are a leveraged financial strength instrument which offers the potential cost outsized gains or losses. So even if kanang secure na ag kanang imong madawat ini ka future, dili ka gihapon free sa risk. So aganing future contracts are not risk free. You may also gain kanang makaginansya ka or pwede po kag maka-gain og losses. So futures or future contracts are also often used to hedge or guarantee the price movement of the underlying asset to help prevent losses from unfavorable price changes. So as I've said earlier, kintahay ag oil karon is mahal, so imong i-lock in ag imong producer kas oil, imong i-lock in ag kana nga price through entering future contracts. So whether muubos na or musaka na sa kanang 1 year later, dili ma-change ag price because you have entered into a future contract. So basically that's it. So guys, remember, future and forward contracts are both obligation. Obligation is siya, dili ka pwede kung mayon ka nga, nga dili na lamang ko, dili na siya pwede ingana. Sa both ends, ni buyer o ni seller. So regardless of any circumstances and price changes, the buyer of a futures contract is nasa the obligation to buy and receive the underlying asset when the future contract expires. So the seller also is obligated to provide and deliver the underlying asset at the expiration date. So guys, naamoy pangutana mao ra to ag ahong part. So that's the future contract. Thank you. So now, let's proceed to the third speaker for this afternoon's webinar, Ms. Mitchell Porca. Thank you.
Once again, I'm Mitch, and I'll be talking about option contract. So, unsa man di ning option contract? As the definition says, it is a contract that gives the holder the right to purchase or sell an asset at a specified price. Meaning, kung unsa ang agreed time na nagkasabot ang buyer and ang seller. And then, during a definite period of some future time. Mao dyan ninyong hinumduman kaadyo. In option contract, there are two dates nga ma-involved. The first date is the date kung kanus asidya naka-decide or naka-project nga in the future nasa gustong paliton. And the second date is the future time, which is kung kanus adyo sidya mo palit na sa iyang gustong paliton. Now, emphasize in here, an option is a right, not an obligation. Later on, towards atong illustration, you will understand better kung ano ni siya nga na-emphasize na siya nga gikot-and-kot dire. Now, let's discuss the terms in option contract. First is the call option. So, ang gain nga din na nasa definition, mao-ning right sa holder to purchase an asset. However, ang kaning put option is to sell. So, muna siya ang duha ka type sa option contract. So, karon nga adlawa, ang ato lang i-focus is the call option. Now, di ba, ang hawang kaning option contract, nag-give na siya sa holder to a right to push through or to cancel the contract. So, meaning, naman siya nga benefit, di ba? So, munang naa siya bayaran nga murag down payment. And that is what we call option premium. For what? That is to protect the holder to any unfavorable movement in price in the future. So to understand better, let's have an illustration. On December 1, 2019, Laban Lang Company projects a need for 100,000 units of raw materials. So meaning, naa si Jai gustong paliton si Laban Lang Company ni July 1, 100,000 units of raw material. Assuming nga ni ka pag sa December 1, 50 pa ang ijang price sa material. And then, given naman jud na nga mga commodities, na jud na changes sa price. It's either mo increase or mo decrease. Mo nang nakahuna-huna si Laban Lang Company nga mo increase siya into call option contract. And mo na siya ning pay siya of 50,000 for the option premium pagka December 1. So gibali pagka December 1 pa laman, protected na siya from any unfavorable changes of prices nig-abot sa July 1 nga mapalit na siya sa raw material. Now, let's have a situation. Dire, makasabot mo kung kanus dapat mo push through sa contract or kanus dapat i-cancel ang contract. So, ang first situation is ang first situation is 55 na ang raw material, ang market price ni gibale 55 pesos na pag-abot sa July 1. So, unsa may madawat nga benefit ni Laban Lang Company from entering into a call option contract? It is, di ba, akong giing ganina, option contract na sa right to push through or to cancel. So, kani nga situation, mo push through ka sa contract para maka-benefit ka. So, instead nga, July 1, instead nga, ang imong bayaran is 5.5 million, which is 100,000 times 55 pesos. As is ra nga, imong bayaran is 50 pesos per unit. So, nakasave gibalik ka. Or, I mean, si Laban Lang Company, which is ang holder sa contract. Now, for the second situation, ang market price is 45 pesos. So, if inyong manotice, no, ang price kay ning decrease siya sa agreed price which is 50 pesos. So, ako mong pangutan-on karon, do you think nga naagi hapoy benefit madawat si Laban Lang Company from entering the contract? Yes or no? Okay, so kani gibale, moving forward, kani gibaling sorry, ang kaning 45 sa kaning situation 2, maka-benefit gihapon si Laban Lang Company from entering the contract. Ngano makaingon man ta nga ngano? It's because ang 45 pesos naman ijang bayran. Di naman siya mo bayad for the 50 nga agreed price. Kaya diba, agreed price jud niya is 50 jud. Instead nga, 5 million ijang bayran, 4.5 million na lamang ijang bayran sa nag-abot sa panahon ni July 1. So, in a nutshell, this option contract is needed because it protects the holder from any risk nga ma-encounter niya in the future nga di siya kahibaw nga na-changes sa prices. And it focuses on kung asa jud maka-benefit ang holder sa contract. And that's it for my...
Pwede na mo?
Di.
Ay.
So,
Ready lagi na. Atong pugson. So, our question number 1 is, how many passed the Sipale October 2021? So, pag-type mo sa inyong answer as after I said go. So, how many passed the Sipale October 2021? Drop your answers in 5, 4, 3, 2, 1, go. So, nana tayo winner.
Congratulations!
Ni Guno Placedo. Gono Placedo. Naa ka dira, Mr. Guno Placedo.
Congratulations.
Amo ra kang i-contact for your reward after this webinar. Thank you. Thank you po sa tanang ni answer. So let's move on for our question number 2. So, for question number 2, what is the passing rate of Sipale 2019? So guys, before mo mag-type og send yung answer, reminder lang na naay mo chat nga hang kauban og start unja ag first nga makasunod ato nga chat is mao toy among i-declare nga winner nga maka-receive og 50 pesos. So drop your answers in 5, 4, 3, 2, 1, start. Passing rate of Sipale 2019. Mao to siya ang pinaka-lowest nga rating sa tanan nga so far sa Sipale. So guys, make sure nga sakto ag bisan pinaka-little nga point sa inyong answer. Pagka sa 2019. Sa October 2019. May 2019 CPA licensure examination. So guys, nana tayo winner. Sakto nga answer is 14.32%. Mao ni ag passing rate sa Sipale May 2019. Si Olive Grace Olvina. Congratulations. Clap mo guys, virtual applause. Yay! Naray mo contact nga kauban na mo for your reward later. Thank you. So now let's proceed sa atong third question. So what GPS stands for? Basic ra jud siya guys. So unsay meaning sa JPA? So drop your answers in 5, 4, 3, 2, start. Meaning sa JPA, so guys, naana tayo winner. JPS stands for Junior Philippine Institute of Accountants. We have our winner, Miss Raquel Rice.
Congratulations!
So for question number 4, man itong last. What is our body number? Manay last nga question. So drop your answers in 5, 4, 3, 2, 1, go. So unsa mi nga body number ag nag-host sa webinar karon? Derivatives part 2. So nana tayo winner si Jane Vermiso.
Congratulations!
So guys, katong mga nagdaog katong upat ka buok, please wait sa
Good afternoon, Junior JPNs. I am Rizal Prima, and my topic for this webinar is embedded derivative. Let's first define embedded derivative. It is a component of a hybrid or combined contract with the effect that some of the cash flows of the combined contract vary in a way similar to a standalone derivative. In simple words, we can say that embedded derivatives require that some part of the contract's cash flow depends on another variable. This variable could be an interest rate, credit rating, currency exchange rate, commodity price, etc. An embedded derivative is similar to the usual derivative with the only difference being its placement. For instance, the usual derivatives are independent products that trade separately. However, embedded derivatives are part of a financial contract, which we can also call as a non-derivative host contract. The derivatives discussed earlier are some examples of the standalone derivative contracts. We have forward contract, futures contract, and the option contract. When a derivative feature is combined in a non-derivative contract, the derivative is referred to as embedded derivative, and such non-derivative contract is called host contract. The combined contract is called hybrid contract. This simply means that there is a basic contract known as the host contract that has an embedded derivative. The host contract might be a debt or equity instrument, a lease, an insurance contract, or a sale or purchase contract, while embedded derivative is the aspect or part of a host contract that presents an exposure to changes in an underlying variable, such as the inflation rate, foreign exchange rate, commodity price, credit rating, etc. Sometimes entities combine the derivatives with some non-derivative items. For example, a contract having a derivative characteristic may be combined in a loan, bond, share, lease, insurance contract, or purchase or sale contract. For example, consider a business contract for a Filipino organization to export furniture priced in US dollars. The host contract is the contract to sell the furniture, and the embedded derivative is the part of the contract that converts Philippine peso into US dollars, just like a forward exchange contract or the FEC. Let's have another example. An investment in bond whose interest or principal payment is linked to the price of gold and silver. In such a scenario, the interest or principal payment will increase or decrease in direct correlation with the price of gold or silver in the market. In this example, the investment in bond is the debt instrument or the non-derivative, while the payments linked with another instrument, which in this case is the price of gold or silver, which is also considered as our derivative component. This derivative component is known as an embedded derivative. Last example. Company A wants to issue a bond, but the payment of the interest is dependent on the price of oil. In this case, the payment would go up or down on the basis of oil price movement. Here, the debt security or the bond is the host contract with an embedded derivative, which is the dependence of the payment to the oil price. Since we now know what Since we now know what an embedded derivative is, the question becomes, why do we need to know this? The reason comes back to accounting standards and the provision of useful information to users of financial reports. Derivatives provide leveraged exposure to underlying variables and can change the risk profile of an organization. So users of financial statements want to know whether there are any derivatives impacting on the financial standing of the organization.
Hi guys, I am Marilyn Abingpuno and my topic is embedded derivatives accounted for separately. The requirement to account for certain embedded derivatives separately was originally intended to serve as an anti-abuse provision. So the people who created these standards actually feared that entities might attempt to embed derivatives in contracts unaffected by the derivatives and hedging activities. So guidance so as to avoid its requirement to record the economics of derivative instruments in earnings. To provide consistency in accounting methods, the effort has been made in direction due to which embedded derivatives are accounted for in a similar manner compared to derivative instruments. For such a scenario, a derivative that is embedded into the host contract needs to be separated, and this process of separation is referred to as bifurcation. So bifurcation is the process of the separating embedded derivative from the host contract. For example, is an investor in the convertible bond is required to separate the stock option component first by the process of bifurcation. The stock option portion, which is an embedded derivative, then needs to be accounted like any other derivative. So this is done at the fair value level. However, for the host contract, accounting is done as per the GAAP standard, considering the fact that there is no derivative attached. So both of the instruments are treated separately and accounted for, as mentioned above. However, it is very important to understand that not all embedded derivatives have to be bifurcated and accounted for separately. A call option within a fixed rate band is a derivative that does not require to bifurcation and separate accounting. So there are criteria or situation which defines bifurcation. So the certain ways in which an embedded derivative needs to be treated for accounting purposes. As per the International Financial Standards, or IFRS, the embedded derivative needs to be separated from the host contract and needs to be accounted for separately. So this condition for accounting needs to be maintained unless the economic and rest of both the host contract and embedded derivative are closely related. So according to PFRS 9, paragraph 4, 3.3, it is provides that an embedded derivative shall be separated from the host contract and accounted for as if it were a stand-alone derivative in the following conditions are met. So first conditions are a separate instrument with the same terms as the embedded feature would meet the definition of a derivative. Second is the combined contract is not measured at fair value through profit and loss. And the third one is the economic characteristics and rest of the embedded feature is not closely related to the economic characteristics and rest of the contract. And the last one is the host contract is outside the scope of PFRS 9. So according also to PFRS 9 paragraph 4, 3.4 provides that this PFRS does not address whether an embedded derivative shall be presented separately in the statement of financial position. Next is host contract within scope of PFRS 9. The host contract is a debt instrument because the instrument has a stated maturity and because the holder has none of the rights of a shareholder, such as the ability to vote the shares and receive distributions to shareholders. So it is simply stated if the host contract is a financial asset, the embedded derivative is not separated. Depending on the business model of managing financial asset, the host contract in its entirety is measured at first is amortized cost, next is fair value through profit or loss, and the last one is fair value through other comprehensive income. And that would be all. Thank you.